Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Adelina Safitri. My PM is 2441109. I'm from Management Class 24A. So today in this video, we're going to talk about material insurance risk management. I will explain about material insurance risk management. It's a vital process that helps individuals and organizations protect themselves from financial losses caused by unexpected events. Every person and business face uncertainty in daily life. So, risks such as accidents, natural disasters, illnesses, theft, cyber attacks, and legal claims can occur at any time. Because it is impossible to eliminate all risk, insurance serves as an important tool for managing and transferring financial responsibility. So, what is insurance risk management? So, insurance risk management is the process of identifying risk, assessing their potential impact, implementing preventive measures, and transferring financial losses to an insurance company through insurance policies. So, in exchange for premium payments, insurance companies agree to compensate policyholders when covered losses occur. So, the primary objective of insurance risk management is to reduce uncertainty and provide financial protection against unexpected events. The first stage in insurance risk management is risk identification. So organizations must identify potential risk that could ever affect their operations. For example, a manufacturing company may face risk that relate to fire, equipment damage, a workplace accident, and legal liabilities. So the second stage is a risk assessment. This involves evaluating both the probability of a risk occurring and the severity of its potential consequences. Understanding these factors helps businesses determine the most appropriate level of protection. The third stage is risk control. Before purchasing insurance, organizations should implement preventive measures to reduce the likelihood of losses. For example, is include employee safety training, regular equipment maintenance, cybersecurity system, and fire prevention programs. So the first stage is risk financing, where insurance becomes an essential tool by purchasing insurance coverage. Businesses transfer certain financial risk to insurance companies. One of the most important concept is insurance risk management is risk transfer. Risk transfer allows businesses and individuals to shift the financial burden of potential losses to insurers. Instead of facing potentially devastating expenses alone, policyholders pay relatively small premiums for financial protection. There are many types of insurance used in risk management. The first is property insurance, which protects physical assets such as buildings, equipment, and inventory from losses caused by fire, theft, or natural disasters. The second type is liability insurance. This protects businesses against legal claims arising from injuries, negligence, or property damage caused to third parties. The third type is health insurance, which helps cover medical expenses and healthcare costs for employees and individuals. So another important type is life insurance, which provides financial support to beneficiaries in the event of the insured person death. Businesses may also purchase business interruption and insurance, which companies for lost income. And then, yeah, in recent years, cyber insurance has become increasingly important as businesses rely more heavily on digital system. Cyber threats such as data breaches, ransomware attacks, and hacking have incidents have become major concerns. Insurance risk management offer numerous benefits. So next is insurance risk management offers numerous benefits. So first is provides financial protection by reducing the economic impact of unexpected losses. Also, second is insurance promotes its businesses continuity, allowing organization to recover more quickly after disaster and disruptions. The third is insurance enhance its stakeholder confidence is investor, customers, and business partners are more likely to trust organizations that are adequately protected against risk. Fourth is insurance support is legal compliance, as certain forms of coverage may required by law in many countries. So the concept of insurance premiums is another important aspect. A premium is the amount paid by the policyholder to maintain insurance coverage. Premiums are generally determined based on the level of risk involved. Higher risk individuals or businesses typically pay higher premiums. Another important concept is that deductible. Deductible is the amount the policyholder must pay before the insurance company begins covering losses. Deductibles encourage responsible behavior and help insurers manage claim costs. So, insurance companies themselves must also manage risk effectively. One common method is underwriting, which involves evaluating applicants before issuing insurance policies. Insurers assess various factors such as age, health, occupation, business activities, and historical loss records. So another technique is risk pooling. Insurance companies collect premiums from many policyholders and use those funds to compensate the relatively small number of customers who experience losses. And next is insurance companies also utilize reinsurance, which involves transferring part of their risks to other insurance companies. Reinsurers help insurers maintain financial stability, and avoid catastrophic losses. Technology has significantly transformed insurance risk management. Artificial intelligence, predictive analytics, machine learning, and digital platforms enable insurance to assess risk more accurately and improve customer service. These technologies help reduce costs, detect fraud, and process claims more efficiently and effectively. A practical example highlights the importance of insurance risk management. Imagine a manufacturing company experiences a major fire and that destroys part of its production facility. Without insurance, the company may face enormous repair costs and operational losses. However, if it has property insurance and business interruption, Insurance, much of the financial burden can be covered, allowing operation to recover more quickly. So the COVID-19 pandemic also demonstrated the importance of insurance risk management. Many organizations experience business interruption, healthcare expenses, and financial uncertainty. Companies with appropriate insurance coverage were often better equipped to handle these excellent challenges and recover from disruption. So insurance also contributes significantly to economic development by reducing uncertainty. Insurance encourage entrepreneurship, investment, and innovation. Businesses are more willing to expand operations and pursue growth opportunities when they know they are protected against potential losses. So that's all about my presentation today. Hope you understand. And then don't forget to like and subscribe. Thank you so much for watching. Assalamualaikum warahmatullahi wabarakatuh.